Well, the stock markets perk up after the status quo policy on Friday. The Nifty holds on to 19,600. However, for the week, the Nifty and the sensex closed flat, while the mid-cap index erased all its gains from last week to end 1% lower. Hello and welcome to the Editors Roundtable. This week, we take stock of the pickup in the FII outflows, put the spotlight on India's consumption sector. We tell you the key triggers for the market next week. I'm Sonia Shanoy, and with me we have the editors Anuj, Prashant, Nigel, Nimesh. It's a full house today. Folks, it's also a very exciting weekend, right? You have officially the World Cup kicking off. So the spirits are high.
And the Asian Games closing as well, and the best ever Asian Games. By the way, after a long time, we have a full house, right?
Yes, we do.
Five of us, the OG as we call it. All of us are there. But yeah, I think the week was truncated, but it was quite an okay week actually. You know, there was something for everyone, for the bulls, for the bears, for the neutrals. I think for the mid caps, large caps. Something for everyone.
I was just saying that Anu said it's truncated. By the time you get to Friday, I don't even remember.
You don't even remember that holiday.
When was that holiday?
So what you can remember, next week is not.
Next week there's no holiday. Anyone going for the match?
I'm trying to at least watch a couple of matches live, so let's see.
Okay, that's
fingers
a good
crossed. If I get the tickets, then hopefully I'll do justice. But anyway, so from the market's point of view, I guess we're just looking at 1% fall on the mid cap, flat on the Nifty and Sensex. But in the context of global markets, the global cues, I don't think we've done a bad job, right? I mean, just a flat on the Nifty, just 1% down on the mid cap and small cap, and even in then, there are a lot of stocks in the broader market which have actually done well as well. Despite so much of weak global cues, there is so much of concerns about bond yields rising, crude was higher middle of the week. So, in a way, I think this week's outcome was not bad given the global context. So, and the fact that despite the FII selling, despite global weak cues, we actually ended in a positive territory for this week, and the fact that Nifty is above the crucial technical support of 19,500 odd level. So, in a way, I would take this as a positive week given the global background.
Oh, absolutely a positive week because, as they say, right, the kitchen sink was thrown at the market this week, but it still held on to that 19,500 mark. And we have so many big cues coming up next week. There's the IT earnings, etc. So, given everything, it was not a bad outcome at all.
It wasn't. And, but you'll have to say that you got some kind of a divine intervention in terms of that big fall that we had in crude. The market was breaking down, Sonia. Make no mistake about it. Yeah. Just about 2 or 3 days back, we were almost staring down the barrel. The Nifty was almost breaking the September low. The Bank Nifty held on to the September low by about 70 points. So we were almost there, and then we had that big divine intervention. Crude oil prices from 98 all of a sudden fell to 85. It was tough to believe that, what was happening. I think that really got the market sort of the kind of help that the market needed. The week ended flat, but there were a lot of individual stock moves. And remember, the mid-caps still underperformed in this week. And barring today, the mid-caps through the week were actually, underperforming or sulking. But what stood out this week was that IT is again showing some bit of outperformance. Of course, there was a buzz of TCS buyback, which got confirmed on Friday evening. But that, I think, was clearly for me one of the stocks of the week. And on the other side, you had metals, where you had some big losses despite today's rally. So those were the two big sectors. And real estate, of course, that did remarkably well. The other thing which was really interesting this week was the return of B2, Bajaj Finance and Bajaj Finserv. I think phenomenal move on Bajaj Finance, all-time high. Bajaj Finserv also, I think, was the top weekly gainer as well. And the other thing which the market liked this week was the price action of HDFC Bank. Yeah. After last week's shocker, I think this week, the fact that it at least ended in the green for the week and didn't really collapse, I think that itself was good news for the market. And of course, ONGC was the top loser after last month's big rally. But, FIs continue to sell. And I think that for me, that always is the worry point that, for how long can the market keep absorbing the kind of FI selling and keep moving on, actually. That, for me, was the other point.
Okay. In fact, let me just get Pankaj Tibrewal into this conversation as well. He's a guest joining us now. He's a Senior Executive Vice President and Fund Manager at Kotak Mahindra Asset Management. Pankaj, thanks a lot for joining in. Just get into this debate that we were having about how the market has been so resilient amidst all the weak global cues. And now we're heading into earnings season as well. How are you feeling about this market now?
I think globally, clearly markets are facing headwinds from higher US bond yields. And clearly, bond yields have moved up by 70, 80 basis points in a very short period of time. I think we should not ignore that. And also, liquidity in the domestic market for the first time has turned negative, partially because of advanced tax outflow, partly because of half year ending, partly because of festivity starting to kick off. But we need to closely watch liquidity in the banking system also. And that has a correlation on equity markets with the lag. And domestically, I think flows are very, very important. We have seen 15,000 crores of outflow in the month of September by FIs after a long time. Domestics have come to the rescue. And just look at the numbers last calendar year. FIs sold $17 billion. Domestic bought $32 billion. This year, domestics are still buyers and FIs are also buyers to the tune of $15 billion. So you have seen the best of the both in terms of flows by both domestic and FIs in calendar year to date, and a large part of market move could be attributed to the flows. If the flows turn negative because of what's happening globally, we need to be a little careful about. Large caps, I'm not so worried. I think the real worry is in the broader market space, and most of the parameters are pointing out that there is some kind of excesses which have got created in the mid and small cap category, and we need to be a little careful on that side.
Pankaj, we spoke on the 9th of September. If you guys remember, Pankaj was on Bazaar, and he had sounded the alarm bell back then on mid caps and small caps. There was a pretty powerful interview, and I think it was widely noticed. Pankaj, do you still believe those warning signs are all there, or not that much time has passed between that interview and now, but a month or so, but it's still as elevated as ever, according to you?
Yes, absolutely, Prashant. I think post that interview, we saw many days of, nervousness starting to creep in.
Correct.
And when you look at the broader market, I think the underlying breadth is starting to get a little negative. Look at the median stock return of the small cap index. For the first time after March, in the month of September, the median stock return of the index has gone negative. Whereas the headline index return still was about 2.5%, but the median stock return of the index was negative. Similarly, the divergence was seen in the mid-cap index as well, where the divergence between median stock return and the index return was about 1.5%, which shows that the rally is getting narrower and narrower. Few stocks are driving the mid and small cap, where the breadth earlier was quite widespread. These are early signs, indicators that market is starting to look fatigued, and some signs of worry may start to emerge. All eyes on the earnings season. Let's see how it spans out. But most of the indicators which I spoke in that interview still holds true. Greed is clearly visible on the street. Market cap distribution and profit distribution disconnect seems to be there. Mid and small now constitute about 34-35% of market cap distribution, whereas when the profit distribution you look at, large caps are about 74-75 and mid and small caps are about 24-25. So there's a disconnect to that extent, and all the other parameters which I spoke about seems to be still there. So I think some excesses are there in the mid and small cap segment, and we need to be cautious about that part. Large caps valuations are not so expensive still.
Right.
18.5, 19 times on forward, 1 year forward, I think still okay.
All right. Actually, as Pankaj said, some bit of fatigue. You call it resilience, someone will call it fatigue. It was that kind of a week. Nimesh, what's the dealing room feedback?
So I just want to take what Pankaj said, just to add to what he was saying as well. I'll give feedback from the both sides, the buy side feedback as well as sell side feedback. From a buy side perspective, the feedback is that now, even the best of the investors are struggling for investable ideas. This week there were ample of examples of some really smart fund managers going down the lane and actually looking for very small cap companies, micro cap companies, and they're investing into those companies, right? And that's showing up in the block deal data. So that's one feedback, that now even the best of the investors are struggling for good ideas in the broader market. From a sell side perspective, I was just looking at the brokerage recommendations in the last 1 month. Virtually every second or every day there has been initiating coverages. In the 1 month itself, there has been more than 30 initiating coverage reports across sectors. Now people are warming up to EMS space. Now people are warming up to tiles names. And so even the sell side analysts are really struggling to push for bigger ideas and newer ideas. So, that shows that now there is a fatigue or lack of, ideas as well, both from the buy side and from the sell side. So that clearly I wanted to put on the table. I've been saying for the last couple of weeks that watch out for M&A activity. I've been saying that watch out for, block deals and promoter sale. Now I think it shifted to larger M&A activity, and that's clearly pointing out I was fortunate to meet a lot of investors, buy side, as well as some bankers as well this week. And the clear feedback is that M&A is something which is going to pick up. And really, there is now, people are really struggling for good ideas to bet on. And that's showing up in the SME market as well. Even forget SME market, there was a small 70 crore IPO this week in the main board. And it got subscribed 300 times. That shows that there is still domestic liquidity and there are lack of ideas now.
Okay, well, the one thing that also stood out is that FIIs continue to be big sellers this week, although the selling pressure reduced towards the end of the week. But there's some data that you've put together, Nigel?
Well, that's right. Let me go to the big ball, actually, and explain this data for us. As this header shows, the FII outflows, well, they have picked up, right? So maybe we take a cue from Frank Sinatra and do it our way. So maybe we are going to be forced to do it our way, because the domestic inflows are going to be very, very important. To put it into context first, well, the FII flows, you just take a look at it. In the month of September, you saw selling after a good 6 months of inflows. And you'll be a little bit worried out there. But the DI inflow has matched up, actually. The DI inflow is close to $2.5 billion in the month of September. Even in October, in the initial part of October, you've seen FI selling to the tune of around $400 to around $500 million. But the DI inflow has been as much. So they're more or less offsetting each other. But don't be so worried, because actually it appears it's not an India-specific problem. The emerging markets in the month of September itself did see selling. All across the board, they were selling. Taiwan, in fact, came in for a harder hit. And India was the next hit by close to around $2.3 billion. Why is this flight moving away? Emerging market funds moving away. One possible reason could be the bond yields, US bond yields, which is obviously a safer investment. Out there, the yields move from around 4% to around 4.8%. If I plot a chart of the 10-year US bond yields, as well as the MSCI Emerging Market Index, well, that's telling you the picture. As the yields moved up, you had some correction on the MSCI Emerging Market Index itself. Well, a couple of factors have played out, though, year to date. And don't be so upset about just a single month. That's in September. You've seen selling from FIs. Because actually, India has been a favorite. If you look at in terms of flows, only India and South Korea, they have seen inflows from the entire emerging market basket. And out of that, India's inflows are nearly twice of what you saw go to South Korea. But it's all about valuations at some point of time as well. In India, though we have good earnings, you have a stable government in India, policies in the right direction as well, we're relatively more expensive, and maybe for good reason as well in comparison to the other markets that trade out there. So let's wind this down then. It appears the onus is more on domestic flows in the near term. And I guess, simply said, we will have to do it our way if, in fact, the FI flows don't come back in a hurry.
Well, that's a very interesting piece. And, touching upon some musical greats as well, Nigel. But, Pankaj, I just want a quick word in on Friday's big sell-off that we saw in bonds and the sharp rise in yields and the market just shrugging it off. I mean, the stock markets. Do you think it's a problem or not really, especially for banks, NBFCs, etc.?
I think if you take a medium-term call, the MSCI inclusion is a big positive, which will start next year. And about $25 to $30 billion of demand will be there. But in the near term, I think what spooked the markets today probably could be the OMO announcement. And that OMO sale announcement probably has taken bond market by surprise. But I believe that maximum, I'm not a fixed income expert. My other team does it. But 735, 750 seems to be a good level from a bond market perspective. So not so much worried, more worried about the US 10-year treasury. At 480, I think the equation changes completely globally. And Nigel highlighted some of the important data points. And there's a decent correlation of 10-year versus MSCI Emerging Market Index. So watch out for that, because if the US risk-free treasury is available at 5%, the risk assessment needs to be very different for equities globally as well.
Okay, let's now also put the spotlight on India's consumption story, right? You got a lot of data that came out through the course of the week and in the last fortnight, actually. So Prashant has put together some of that.
My turn to walk to the wall.
And what's the song you're singing today?
I don't know, Nigel. I'll come up with something, guys. Let me just quickly tell you, what I'm talking about, right? So I think this kind of tells you, in a snapshot, consumption is weak, but capital expenditure, especially government capital expenditure, is strong, and it's a clear kind of dichotomy. These data points will speak for themselves. Look at volume growth in the first quarter for all these companies, right? Abysmal. Britannia, 0%. Lever, Page Industries, Jubilant Food, Phoenix, of course, a little better. Nykaa, which is a little better. I mean, actually, as you go up the value chain, As you go into the slightly more premium segments, things are looking better, but at the lower level, it's bad. This is consumer durables. I mean, ACs, fans, washing machines, white goods basically. And look at what we've seen through the course of the last many quarters. In the last quarter, it was negative 15% year-on-year growth for consumer durables. Now look at car sales. Again, I'm talking about the lower end. So these are, the entry-level segment under 7 lakh. Car sales are down 2% in FY24 till date. The entry-level hatchback segment. Look at bike sales. Similar kind of data point. Economy under 1 lakh is basically what we are using. 125cc. The number is minus 6% for bikes, entry-level bikes. Look at imports, right? I mean, the amount that an economy is importing will give you a sense of the needs for the growth and the amount of import needed to kind of finance it, fund it. This is non-oil, non-gold, non-capital goods imports. It's down 6% FY24 year to date. So it's pretty clear. The data tells you that consumption is actually on a weak footing, and stocks have been saying that for some time now. This is government expenditure now. On the other side of the coin, central government capex is up 52% in FY24 so far. Look at state, and this is on top of the 24% growth that we saw the previous year. You look at state government capex, 42% growth after a 3.5% growth that we saw, the previous year. Look at sectoral splits that I could find. Railway, 68% growth, defense, 16%, roads, just about 1%, but roads saw a very large growth in FY24. So it's pretty clear that government is spending while the consumer is being pretty tight-fisted. The question is, will consumption, as we are in the sort of embarking into the second quarter earnings season, will consumption pick up in a meaningful way? The other question is, if consumption continues to be slow, why do companies need to add more capacity, right? I think that's a valid question. Or will strong government capital expenditure lead to higher consumption, the trickle-down impact? It will create more jobs, more incomes, and that will finally sort of make it into the hands of the consumer. That's essentially the dichotomy I want to present. Let me actually put it to Pankaj. Pankaj, what do you make of the data, and what's your sense? Will we see a sustainable pickup?
Prashant, we are as confused as the data you showed, and it's a real dichotomy that last 3-4 quarters, if you look at, consumption has been extremely weak, and especially the bottom of the pyramid, the mass consumption items across automobile, consumer durable, consumer staples, all you mentioned is absolutely right. And on the other hand, the investment cycle is extremely strong. You look at the cement demand, you look at the power demand, you look at the order inflow, the sanction of banks towards new projects, all are showing very strong pipeline. So we believe that it's a matter of time, and this investment will not stop because one is consumption related, and the second is also export and import substitution led. So I think altogether, you don't forget that this last year, FY23, corporate India, the top 500 companies generated $80 billion of free cash. Now that the balance sheets are delevered, that will go back into the expansion mode. So I think government has done the heavy lifting from the data which you also showed for the last 5-6 years. I think now it's the time for private sector to kind of take the baton. And going forward, our belief is that capex will continue. And your third point, we believe, will be true with a lag of 18 to 24 months, that investment cycle pickup, capex pickup will probably lead to higher consumption as you move ahead. But in the near term, yes, consumption is weak. However, our belief is second half, we should see pickup in consumption. Sure. There are 3 factors to it. The first one is the wedding season. There will be 35 dates. This will be one of the highest wedding season in the last 4-5 years. Okay. The second is the election spend, and the third is the festivity. So all the 3 combined, we believe second half could be far better from consumption and discretionary spend compared to the first half.
All right. On that note, let's thank you, Pankaj. Have a great weekend, and thanks for joining us on the channel and taking the time out. Let's slip into a quick break. On the other side of the break, we'll tell you what to expect from the second quarter earnings season that kickstarts this next week, and also a lot of other triggers that the market is looking at. Stay tuned.